Most investors believe that when they buy a stock, fund, or other financial asset, they become its legal owner. The idea feels intuitive because the investment appears instantly in their account, and they can see its value change in real time. This experience creates a strong sense of ownership, but the reality behind the screen is far more complex and far less direct. In the traditional financial system, ownership is not determined by what appears in your app. It is determined by official legal records maintained by institutions you rarely interact with. These records exist to manage risk, enforce regulations, and maintain order across global markets. As a result, most investors do not own their investments in the way they believe they do. When you purchase an investment through a broker, your name is usually not written on the central ownership ledger. Instead, the asset is registered in the name of a broker, custodian, or nominee company acting on your behalf. You are classified as the beneficial owner, meaning you are entitled to the economic benefits of the asset, such as dividends or price appreciation, but you do not hold direct legal title. This distinction between legal ownership and beneficial ownership is critical. Legal owners control the official records, while beneficial owners rely on contractual promises. In normal market conditions, this difference rarely matters. The system functions smoothly, and investors receive their expected returns. However, during periods of financial stress, the separation between control and benefit can become a serious vulnerability. The reason this structure exists is rooted in the history of financial markets. As markets grew larger and more complex, it became impractical to register every individual investor as a direct owner. Centralized record-keeping allowed institutions to process trades efficiently and reduce administrative burden. Over time, this system became the global standard, even as technology advanced far beyond its original design. Because ownership is layered, your investment exists across multiple databases. Your broker maintains one record showing what you are entitled to. A custodian holds the assets on behalf of many clients. A central securities depository maintains the master record that determines legal ownership. All of these systems must remain perfectly synchronized to prevent errors or disputes. This layered structure means that your access to your investments depends on the stability and integrity of intermediaries. If a broker experiences operational issues, legal trouble, or insolvency, investors may temporarily lose access to their assets, even if those assets still exist on paper. While regulations and insurance mechanisms are designed to protect investors, they do not eliminate risk entirely. Another overlooked aspect of ownership is voting and control. Shareholders often believe they directly influence corporate decisions, but in reality, voting rights are usually exercised through intermediaries. Instructions pass through custodians and brokers before reaching the company, creating additional layers where errors, delays, or limitations can occur. This further distances investors from direct control over their assets. The traditional system requires trust at every level. Investors must trust their broker to maintain accurate records, custodians to safeguard assets, and central institutions to enforce rules fairly. This trust-based model has supported global markets for decades, but it also concentrates power and control in the hands of a few large entities. Understanding who truly owns your investment reveals a deeper truth about modern finance. The system is not designed around individual ownership, but around institutional efficiency and risk management. While this structure enables markets to function at scale, it also limits transparency and direct control for everyday investors. This realization is one of the reasons alternative financial systems are gaining attention. Technologies like blockchain challenge the idea that ownership must be indirect and mediated. They propose a model where ownership is recorded transparently, transferred instantly, and controlled directly by the holder rather than by intermediaries. We will explore why transactions in the traditional investment system take days to settle, and how this delay creates risk, cost, and opportunity for change within the financial system.